I'm Charlotte McLeod with investingnews.com, and here today with me is Jeffrey Christian, managing partner at CPM Group. Thank you so much for being here. Great to have you as always.
As always, it's good to talk to you, Charlotte. You have some of the better questions that get asked of us. Yeah.
Well, I always try my best. And I think today is a great time to be speaking with you, given everything that's going on with gold and silver and the rest of the precious metals. Gold was having a price decline last week, and I know that investors had a lot of questions about what was causing that. So from your perspective, what was behind that fall in the gold price last week that we saw?
A lot of information is secret in the precious metals markets, spot purchases and sales, but you get the ETF data. And if you look at the ETF data, you saw gold ETF holders liquidate 1.6 million ounces of gold between the middle of May and late last week. And that's really was the major factor. So then you can say, well, why were they selling? And, I hate to say it, but one of the reasons they were selling is that the price has been falling since it reached its peak in February. And a lot of these ETF investors are not traditional buy and hold physical gold and silver buyers. They are more opportunistic. They saw the gold price rising after August through January, and they bought ETFs. They bought an enormous amount of ETFs in that 5-month period. And then since February, they've been just selling, and they accelerated their sales pace over the last 2 weeks, partly because the price was falling, partly because the stock market was rising, and partly because the economy looked better than they had expected it to.
Okay, I think that gives us a good idea of what was going on last week. And as we were having that fall in the gold price, it was generating, I think, a lot of discussions on whether we have seen the bottom for gold. So I'm curious to get your thoughts on that. Do you think the bottom is in, or can gold fall further from where we saw last week?
The price can fall further from where it is. I mean, we've been saying that we thought that the price would consolidate it in a very volatile range between April and August, through August. And the range so far has been like $4,065 last week, and say $4,900. The potential for it to spike down and actually touch 4,000, or even go down to 3,800, which is where a lot of technical people are looking, I think that's a reasonable bottom. But our view is that the price moves sideways in a very volatile fashion for the next 2.5 months. Whether it gets below 4,000, I don't know if that's going to happen. These are very volatile markets and very volatile and economically uncertain times, and investors are flopping around back and forth.
Yeah, I remember when we spoke in March, we talked about that trading sideways, but the price will be volatile. So it sounds like that's what we're going to be seeing, at least for the summer. What would you say is the upper limit on that range? We've talked about the lower, but what would be the upper?
Somewhere between 4,800 and 5,000, I think, is the range for the next couple months. We do think that it goes higher after August, into the final 4 months of this year.
Okay, and we'll get into that a little bit later. I wanted to speak about gold price activity that we're seeing today, because after last week's decline, this week we're seeing a rebound. We're talking on June 15th, so it's Monday, and we've had this news of a potential peace deal between Iran and the US. We'll see how that plays out, but to what extent do you think that price rise that we're seeing is related to that? Is it highly correlated to that, or are there other factors at play?
I've been shocked over the last several weeks because President Trump has continually said, "Oh, we're going to have a treaty. We're going to have peace." I mean, he started. He attacked on February 28th, and on March 1st, he said, "Well, this will be over in a day or two." And March, April, May, half of June, for 3.5 months, he keeps saying, "Oh, we're on the threshold of a deal. We're talking now." And the Iranians say, "We're not talking, and we're nowhere near a deal." And even if you look at the current deal, but I've been shocked at the extent to which precious metals and market participants and others in equity and bond markets have paid any attention to what this guy says. I mean, he's a serial liar and he's a serial dishonest about this. And yet, he was saying last week, oh yeah, we're a couple days away from having a peace agreement. And I think I know people who were selling based on that idea. And we were saying, you've got to be kidding. You're selling based on what this guy is saying about this. Now, if you look at the present, what they've got is a memorandum of understanding, which says, hey, we're going to have 60 days of further ceasefire, during which time we'll resolve everything else. Now, I was listening to the details yesterday and I turned to my wife. I said, are these guys that naive? Because in 60 days, the Iranians are not going to agree to give up the uranium. They're not going to They're not going to agree to give up their defense, including nuclear power, weaponry potential. And the United States is not going to give up on its side. So in 60 days, Trump is going to have to resort to his bluster again, because this is not going to be resolved in 60 days. But what will happen is in 60 days, you're going to be in the middle of August, which means that you're going to be, 8-10 weeks away from the midterm elections. So he's going to have a tougher domestic political environment in 60 days than he has now. And he's set himself up for that. So I'm surprised and shocked that people have actually bought and sold stocks, bonds, currencies, and precious metals based on him saying, oh, we're 2 days away from a treaty. And I think that the memorandum of understanding that is being worked on this week, although he said it's been signed, he's in Paris now for the G7, or in Evian for the G7. And he said today that it's been signed. It hasn't been signed. It hasn't even been written yet. He's just setting himself up for further chaos and uncertainty.
Yeah, I almost hesitate to bring it up because there is so much uncertainty, but I think it's worth talking about. And it's interesting to see your surprise at how people have reacted to the Iran war in terms of gold. I think among our audience, I've seen a lot of questions about why isn't the gold price higher when we're in this situation of conflict and geopolitical turmoil. So do you think that also ties into what you've been noticing about how people are reacting?
Well, yeah, and we're in a tough period now, and one of the things that we pay a lot of attention to is the way gold and silver investors buy and drive the price higher in times of severe economic and political problems. And you saw this in the Depression, you saw it in World War II, and I think you're seeing it now, where, there's an initial rush to buy gold and silver and the prices go up high. And then there's a pause when it's not that the chaos and risks and uncertainties and anxieties are normalized, but they are to some extent. I guess that, I don't want to use that term because it's not like a long-term normalization, but there's a pause or a plateau where people say, okay, I've got my gold and silver. Now let's see what happens. And that's sort of where we are right now. And as far as we can tell, we're in a position where people have been buying a lot of gold and silver, in concerns about all of the risks, not just Iran, but all of the risks and uncertainties that the world's facing. The economy is showing up a little bit stronger than people thought. Employment data is showing up stronger. Unfortunately, inflation is also pointing toward higher prices, which is suggesting higher interest rates, which is sort of a headwind to some extent, for gold and silver. So, you're sort of in this pause period right now. And again, we think that pause period could last for a couple months now before we see another wave of investor anxiety pushing prices higher.
This is going in a direction I wanted to ask you about, which is that level of global risk and uncertainty. When we spoke in March, you were talking about how at a global level, I believe it was higher than we had seen since Pearl Harbor. I wonder, so have you seen the global level of risk increase or decrease since then? I know you said that people are kind of in a holding pattern, but how does it look?
I think, I'm not sure that it's increased, but I don't think it's decreased. I think, in reality, one of the things that we've seen since March is that some of the federal judges down from the Supreme Court have taken a more legalistic approach toward a lot of the things that Trump has been doing. So you've seen a lot of things that the Trump people have been doing being rejected by the courts and being reversed by the courts. You're seeing perhaps a little bit more effective counter effect on a political level, including some Republican senators and Congress people who feel that kowtowing and falling in line with Trump could cost them their jobs and political careers, and they'd have to become lobbyists if they lose. So you're seeing a little bit more political fight back. You're seeing a little bit more, again, that normalization. If you go back to March, there was a tremendous amount of activity about ICE. ICE was being very militant. They were shooting people. They were grabbing families. At one point, they actually imprisoned a 2-month-old baby, a suspected terrorist. And there was increased opposition to ICE and DHS. If you go forward to today, ICE has backed off. There's less visible opposition. The head of Homeland Security is gone. They brought in somebody else who's trying to sort of backpedal things. They're selling off some of the planes that Kristi Noem bought. They're trying to get out of contracts for these warehouses where they're going to try to put 10,000 or 1,000 people in a place with one bathroom. So you're seeing some pushback. It's not that the risks have deteriorated or been reduced. It's that you're in this stasis period. You've seen the initial thrust, and now you're in the trenches waiting for the next push forward. And the next push forward will come, and it will probably come before the election. And it's going to include a lot of efforts to interfere with the elections, to have federal agents at the polling places with guns, and to have federal agents seizing from the states. The states have the legal right to the ballots, but the federal government's saying that they're going to take them, which is in violation of the Constitution, et cetera, et cetera. So I think you're going to see that next thrust. And this is the point where the administration recoils and sets up for an autumn offensive, and the opposition is also gearing up for an autumn defense.
That makes a lot of sense. And talking about things being in stasis right now, I want to bring up also the Fed meeting that's coming up later this week. I think the very broad consensus is that we won't see a change in interest rates, but I'm sure everybody will be watching very closely the commentary from Warsh. So I wonder what you'll be looking at there. It'll be his first meeting as Fed chair.
Yeah, I think, he's got a really interesting position this week in that he has to convince the real people. He has to convince that he is an honest and intelligent and with integrity person are the other members of the FOMC. He has to convince them that he's serious about being an independent, honest Federal Reserve Board chairman. And we've seen political hacks in the past, in the 70s, when we had very volatile inflation and economic activity as a result of a variety of issues, including politically inspired Fed chairman. So he's aware of that. He knows the history. He's going to have to convince the other FOMC members that he is a honest and intelligent person to be there in the chairmanship. He's got to convince financial markets and the broader economy. The consensus, the last time I looked at FedWatch, which was last Wednesday, so the last trading day, was 96+% assumed that the Fed, that the interest rate would be unchanged. About 3% said that they thought there might be a 25% BIP decline, 25 BIP decline. And no one was expecting an increase in interest rates, which I think is probably skewed to the wrong array. My view is it's unchanged to maybe even higher, because last week we had very high problematic CPI and PPI, and it wasn't just the energy prices. Obviously, the energy prices were very important, but if you looked at the other segments of consumer and producer prices, you had a lot of issues, and some of the issues with transport on the PPI. Transport's obviously more costly because of the energy costs of the fuels. So you've got a lot of problems. So Warsh has got to demonstrate that he can be honest and effective and independent. But he also has to be careful about Trump. Now, Trump has signaled, hey, I don't care what the Fed does anymore. And I don't care, if they don't lower interest rates. So Trump has signaled to Warsh that it's okay for Warsh to try to establish himself as somebody who can be trusted. But it's going to be a very interesting thing. And it's going to be very interesting to watch his comments after the FOMC meeting, because that's where he's going to prove himself or disprove himself. The vote itself will be very interesting. I assume he will vote to keep interest rates unchanged, but we'll see, if there's dissent to that concept, if that's what the FOMC ultimately decides that it's going to do.
Sounds like he'll be walking a very fine line there. So we'll keep an eye and see what happens with the Fed. I want to go back to those CPI and PPI numbers that you mentioned from last week that were problematic for inflation. I wonder what your outlook is for inflation moving forward. I know right now we have, of course, with this potential peace deal that may or may not pan out, talk of reopening the Strait of Hormuz, but there's already been so much damage and disruption to supply chains. So what are your thoughts?
Well, I do think that, at some point the energy prices, they have already fallen some, and they'll probably continue to decline somewhat. They're not going back to pre-February levels, so I think that energy prices will remain high. And again, people conflate inflation, which is the change in price levels, with the actual price levels. And unfortunately, I think that price levels stay high in the United States and in other countries, and quite frankly, much more problematically in other countries, in India and Southeast Asia and other countries than in the United States. I think that price levels stay high, and the cost of living relative to income will continue to be restrictive of consumer spending, and that's going to be very problematic. But I think at some point the rate of change, the rate of inflation increases will come back down. Probably not down to 2%, though. I don't think you're going to see 2% for at least a few years.
Yeah, the 2% feels quite unattainable, at least at this point. I wonder if we can also take a look at the broader U.S. economy, and if we put together these factors, what your outlook is looking like there. How is it looking as we continue on into the second half of 2026?
We have for several years, like since 2021, 2022, we have been saying that we thought there'd be a recession sometime 2025, 2027. And our current long-term economic outlook still has a recession there. And we're actually, 2 months late in updating it because we're struggling with it. On the one hand, the economy has been stronger than CPM and a lot of other people thought. And there are greater volumes of consumer spending. Debt is rising. Consumers are living off of credit cards and credit. They're spending more than they're earning, but they are spending, and that continues. And the administration is counting on it. It was really amazing to hear them talk on the Sunday morning talk shows. Businesses also have started to invest more, although they can come back. And that's skewed. We're working on trying to get good numbers. A lot of that's skewed by the increase in AI and data centers and cryptos. And a lot of the money is being put into those things, which makes business investment look better than it really is. A lot of bread and butter industries and businesses are suffering in terms of their profitability and their investments. And so you have a lot of issues. Bottom line is that on the one hand, the economy looks like it could continue to bump along, but it could easily tip over into a recession in yet this year, even in the United States. And if you look at other countries, they also are at increased risks of tipping into recessions than is the U.S. So both on a U.S. basis and on a global basis, the economic outlook remains extremely uncertain and perilous.
Yeah, I believe here in Canada, where I am, we're in a technical recession already at this point. So we'll keep an eye on that. I know you've been looking for that for some time in the US. So for gold, we've talked about the Iran war. We've talked about what's going on with the Fed. I wonder, those are top of mind for investors. For you, what other key gold price drivers are you keeping an eye on right now that we might be overlooking?
Well, obviously we're paying attention to central bank purchases and sales. You saw some pretty heavy sales by Russia and by Turkey. You take those out. You had some sales by a couple other, like I think 4 other countries in the first quarter. No other country was selling gold in April. If you look at the buy side of the ledger for central banks, you've seen more central banks buying in the first quarter. They backed away in April, and they seem to have backed away in May as well. But you are seeing central banks continue to buy. They're perhaps reverting more to price sensitivity, waiting for the price to fall. And so we're watching that. We're watching overall investment demand. I mentioned the ETF investments earlier, I think. But we're also watching physical demand. Physical demand is really messed up in India right now because of the economic stringencies caused by the fact that the Indian economy is heavily involved with both imports and exports from the GCC, from the Persian Gulf region, including Iran. And the war and the trade disruptions have really hurt the Indian economy. They're starved for foreign exchange. They put on import controls for gold and silver. And you're seeing investors who hold an enormous, record. There's more gold and silver held by investors in India than any other country in the world. But what we've seen over the last year, and it's increased this year, is they're not selling the way they used to. There used to be a flow back and forth that those people who hold gold and silver, if at all possible, they're holding on to their gold and silver, and they're using their rupees to live right now. So you're seeing, kind of a mixed investment demand picture there. In North America and Europe, you've seen a fair bit of physical selling, more so in silver than in gold. But there have been investors who have been taking profits at what are record prices, and they say, oh my God, gold's down $1,500 Friday from its peak in January. Yes, but it's higher than it's ever been prior to October. So there are any number of investors who bought a long time ago at much lower prices who are saying, I'll take my profits here.
I think that helps give us a picture of what's behind gold. And so we talked about how this summer it looks like gold is going to trade in that range that we spoke about. But you're seeing higher prices toward the end of the year. I wonder, is there a specific trigger that you think would break gold out of this range? How are you looking at that?
Well, there's a whole bunch of things that we're watching, and it would be some combination. People always say, what's going to cause the next recession or what's going to cause, and it's always a combination of factors. And so it's a combination of factors. We are looking for weaker economic trends in the third and fourth quarter in the United States and elsewhere. We are looking for the U.S.-Iranian war to actually continue. And we think that the agreement that's been, the memorandum of understanding that is supposed to be signed on Friday simply kicks the can down the road. Yeah, and they have 60 days to reach an agreement on all these terms, and they will not reach an agreement. I mean, Iran's not going to give up its uranium. Iran's not going to give up its military defense development programs, including the potential for nuclear weapons. And the United States is not going to give up some of its demands. So the Iranians have looked at the U.S. domestic political situation and said, these guys are willing to walk into a trap. So you've got a problem right now, and more people in the United States are mad at the Trump administration for this war and for the economic consequences within the United States of this war. And the Trump administration said, let's put this all on hold for 60 days until we're 60 days closer to the midterm elections. Right? So the Iranian negotiators are fully aware of the U.S. political system, and they know that in the middle of August, when those 60 days are up, the Trump people are going to be even more desperate to try to put lipstick on this pig. And it's going to be more damaging to Republican efforts to maintain the House and Senate. So it's almost like the Trump administration incredibly naive to reach this to agree to a memorandum of understanding saying, let's wait until it's even more dangerous for us to have this hostility. What are you going to do in November? In the middle of August, are you going to say, okay, now we're going to start bombing again? We're going to increase the war effort? Meanwhile, you still have Ukraine. Trump's in France this week for the G7. The G7 is like really upset with the U.S. administration, as is everybody else. It's just there's all kinds of economic and political issues that could come together in the last 4 months of this year to cause investors to say, the price of gold went from $2,600 to $5,000 between August and January. August 2025, January 2026. What's it going to do this year? And I think that our expectation is weaker economic conditions, continued political problems, continued war between the United States and Iran, possibly other political conflicts arising, ongoing problems with the Ukraine, issues related to the Trump administration's relationship to Putin. We haven't even talked about North Korea, China, and Taiwan. There are all kinds of issues that probably will come together and create an ill-easy feeling that's going to cause investors to say, okay, and where's the stock market? Is the stock market going to be at a record price? Are more and more investors going to say, oh my God, the stock market is at a record price because there are all these shell companies, AI and spacecraft. Let's be honest. That thing's never going to be profitable. No investor will invest in SpaceX waiting for the dividends. It's a joke. The stock market has done very well because a few companies of spurious economic value have had very sharp increases in their stock prices. That means that it's extremely vulnerable to a 10, 20, 30% decline later this year. So there are any number of factors that could come together and make this very fine mulligatawny soup that takes gold back up over $5,000.
I know there's always this temptation to pick out the one factor that's going to do it, but yeah, it does sound much more likely that it's that mix of things that ultimately comes together. So maybe we leave gold there for now and take a look at silver. Silver, if we look back at, say, over maybe the last quarter, Q2, Would you say that the price has mostly been driven by the same factors as gold, or are there any silver specific factors that stand out to you?
There are, you're seeing a lot of fabricators look to reduce their silver use per unit or get out of it. And you've seen, a couple solar panel manufacturers getting out of it, and other fabricators there. I was at the International Precious Metals Institute's 50th anniversary conference last week. And, the IPMI has a lot of refineries and scrap dealers and fabricators and the financial institutions that provide financial services to them. And, there was big talk about the enormous amount of silver that investors have sold, over the last 2.5 years, and large amounts of like unsold, if you're selling medallions or 100-ounce bars or kilo bars, silver, that stuff's you're going to get a discount to the spot 1,000-ounce bar, good delivery bar price when you sell that back as an investor. And then that stuff's going to get refined, recast into 1,000-ounce bars, which can be sold into the international market. And that volume has been increasing. But if you have Maple Leaf or Silver Eagle or other coins that have a premium to the spot price, the dealers will hold on to that, waiting for new investors to come in and say, hey, I want to buy these. You say, well, I can buy new ones from the RCM or the US Mint or whomever, or I have, last year's mintage that I can sell you right here at a better price. So there's an enormous stash of silver coins built up in the market. There's a lot of silver that has been going off to the refineries to be melted down. The refineries have been backed up at times, and they've actually stopped accepting their traditional scrap, the processed scrap from refineries, from fabricators, and the end of life electronics and jewelry. That there's been rejections of that by refiners because there's so much metal. So you're seeing an increase in secondary supply. You're seeing reductions in fabrication demand to some extent, or at least in the growth rate of fabrication demand. And you're seeing some investor hesitance to continue to buy. So we've seen the price come down from that peak of 120, and it's been trading between, say, 60 and 90. Probably going to continue to trade in that kind of broad sideways range until we see later in the year.
All right. So it sounds like on the demand side, reduced demand both on the retail and industrial side for silver. Is there anything significant that you pull out on the supply side for silver? Anything from the miners? Have they responded to higher prices or not so much? I also know a lot of silver is a byproduct of base metals mines and that kind of thing. So anything you'd pull out there?
Well, again, as I said, there's a lot of scrap coming in, and a lot of it's been investor material as opposed to traditional scrap. But you are seeing traditional scrap come in. Mining side, you'll see a much slower response. But yes, the mining industry is responding to the higher prices. They have enormous reserves and resources that they can develop, but that's going to take a long period of time. You are seeing a couple companies, go public and raise money, and that's going on. In terms of the byproduct producers, you have seen an increase in hedging of byproduct silver. They still won't hedge their primary products because they want their investors to think that they're fully exposed to the upside, even at the risk of being fully exposed to the downside. But they will hedge their byproduct silver. And we have seen an increase in hedging. But, the mining sector is going to take several years to respond to higher prices, in contrast to the scrap business, which is almost immediate.
Yeah. I think we have to always remember how long it can take. So in terms of the price, it sounds like similar to gold, trading sideways with volatility over the course of the summer. I think you said between that 60 to 90 range. And then potentially is silver going to move higher again with gold toward the end of the year? I think a lot of people are wondering, can it take another run at that $100 triple digit level?
I think it can take another run at that, and we're working right now. We're going through this whole issue. It's a very interesting time for silver and for gold because you've got the fundamentals of mine production, secondary supply, and fabrication demand sort of suggesting that prices are too high to be long-term sustainable. That doesn't mean that they can't stay this high for 3 or 5 years, but, in the long run, beyond 5 years, they're probably unsustainable. But the other fundamental is investment demand. And it says, prices can stay this high as long as the economic and political risks and uncertainties are there. We're not going to let up on our interest in having more of our wealth in gold and silver until the world looks like a safer place. So you tell us when the world's going to be a safer place, and we'll tell you when the prices of gold and silver could fall. So I do think that the price of silver will make another run to $90 and $100. And I think that it could stay high for a period of a year or two more, and maybe even longer, depending on how the rest of the world develops or doesn't.
I think that's helpful in terms of looking at silver. And I want to spend at least a little bit of time on platinum and palladium as well. So I think that platinum moved similar to gold and silver back in January, where it was going up to new all-time highs. Palladium maybe a little bit different. It had its all-time high, I think, a few years ago at this point, so it wasn't really following along. What would be your key takeaways from their performance so far in 2026?
Well, one of the things that we're seeing is increased expectations of lower prices. And so in the market, when you talk to bankers and traders and fabricators and refiners and mining companies, there's a view. You look at the gold, the platinum and palladium prices, and platinum was running $800 to $1,100 from 2015 until last May. And then it broke above 1,100 and it made this run to like $3,000. And now it's back down to 1,700 today. 1776 as we speak, in honor of the U.S. Anniversary. But there is a view that spike really was investor driven and speculative driven, and that the bloom is off of that rose and the price is coming down. And it's very interesting because like we had London Platinum Week in the middle of May or late May, and then we had the IPMI last week. And again, the dealers and the traders and the refiners were saying it's very interesting because they almost all thought that the platinum price and palladium prices would fall. But when you ask them how low they would fall, they said, well, we think that the bloom is off the rose and these things are coming down and they're not going to rise back with gold and silver because it was a matter of marketing hype that started that. And then there was this momentum, and we saw the momentum reverse in February and March. You've seen heavy ETF investor sales of platinum, not so much in palladium. So then you say, so how low do you think it's going to get? And they say, well, I wouldn't be surprised to see $1,500. That's not low. 1,100 would be low. And I don't think it's going to go back to 1,100, but I do think there's downside potential. In palladium, it's pretty much the same sort of situation, but a little bit more bearish because investors are less involved in the palladium market than they are in the platinum market. So the palladium market, I think, is more vulnerable to those other fundamentals, mine production, secondary supply especially, and fabrication demand. And fabrication demand is, a big part of it's auto, but the auto industry, while it's up, auto sale production and sales are up in most major markets slightly this year. They're at risk that they could come down. And so I think that there's a greater pessimism toward platinum and palladium. And I don't know that the prices rise back the way gold and silver does.
Very interesting. And I did want to bring up the auto industry element for platinum and palladium. I know when there is a price differential, we can see substitution between them. And there is one right now. So I wonder if that is something that's playing out in the auto industry at the moment, or they're not ready to do that right now.
There's substitution and then there's substitution. And you can, within an auto model year, auto companies, there are people in the platinum mining side that will tell you this is not true, but the auto industry will tell you it's true. The automakers multi-certify their cars. In any jurisdiction where you're selling your car, you have to certify this car meets your emission standards with this size of engine and one of these different catalysts. And that gives you the capacity within a year to shift a little bit more to the palladium or a little bit more to platinum. So that's the lower case substitution. Then there's the larger case substitution, which is let's make a major change on a more longer term basis. And that's going to involve changing the fuel injection system, the engine, the exhaust system, and the catalyst. And the substructure. When we first started using catalysts, the substructure was a metal grid, and the muffler and the tailpipe and the catalyst were sort of like wired to the bottom of it. But for the last several decades, the undercarriage of a car is a molded metal sheet, and it's got indentations. This is where the muffler goes. This is where the catalyst goes. So if you're going to change between platinum and palladium, with palladium, you're going to move the catalyst closer to the engine because it needs a higher temperature. And with platinum, you're going to move it further away because the higher temperature will actually reduce its effectiveness. So one of the reasons why you saw a very slow transition when the palladium price was so expensive relative to platinum was that they had to re-engineer the undercarriage, the engine, the fuel injection system, the whole vehicle. That's been done, but going back and forth that way, I was actually looking at a brand new car the other day, and for some strange reason, I was looking at the undercarriage, and yes, it's molded for a platinum intense catalyst. So the capital substitution is much slower to happen, and you probably wouldn't see it unless platinum's, I guess, about a $400 premium to palladium right now. You're going to have to see that persist for several years before that uppercase substitution occurs. That doesn't mean that you can't have the lowercase substitution going on, which you probably are seeing.
That's very helpful. I didn't really know that there were those two different levels to substitution. So I think that will help people understand what's going on. All right. I think we've done a pretty good job covering gold, silver, the platinum group metals. I will let you go unless you had any final thoughts that you want to leave investors with right now.
I think, we talked about the fundamentals of those four markets. And then there's the broader issue, which is, the economic and political environment. And part of the economic and political environment is a deterioration in the quality and integrity of information. And it's always been an issue. It's always been an issue in precious metals. It's always been an issue in politics. It's always been an issue. Churchill said that truth is the first casualty of war. But it's gotten much worse. The amount of misinformation and conscious disinformation and trolling and all this stuff. And that just makes it that much worse for an investor to decide what it is. And, there are people, the Russian government, the Soviet government going back to the 30s, said, we want to sow disinformation in the West, in the United States and Europe, because we want people to stop thinking that they can believe anything their governments say. And now you've got governments saying, hey, we want to do the same. We want to beat people into intellectual subservience, where they simply say, oh, you can't believe anything that anybody says, because that opens it up to tyranny. And it's gotten much worse, and it's going to get worse with all of the AI and other stuff.
Well, I think that's an important warning to end on. So thank you so much for coming on once again to talk about precious metals and the broader economy. I think this was really great.
Thanks for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Jeffrey Christian with CPM Group.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.